Michael, always great to have you. I have no idea why you don't cover Warner Brothers Discovery, but I want to ask you about it anyway. I don't because the numbers were not good. I mean, the cash flow estimates for next year, they cut, what, $1.5–2 billion off that number. What's your take, to the extent you can share one without actually formally covering the company?
Well, David, we cover it, but Robert Fishman on our team covers it, so we cover it.
Oh, that's why. But, got it. Okay,
yeah,
sorry.
Yeah, we want to build out our coverage, and I'm doing so many different things, but we have a point of view, and I have a point of view, as you know, and we do cover it.
Okay, good. I was confused for a minute. I apologize. You're right.
No.
Your firm is growing so rapidly that I can't keep track of all the new people who've been added. But let's talk Warner Brothers Discovery. Give me your take overall and what it really means. You know, we got Disney reporting later in the week as well, for example.
Yeah, I think this is incredibly hard transformation for Warner Brothers Discovery, right? The company is levered 5 times. They're relying on old linear cable networks. They have to compete in streaming with all these bigger companies that are willing to lose money. It's a really tough place for them to be. So when they talked on their call about their view of streaming, we share the view. You know, it's not a great business. It requires tons of investment capital, but unfortunately, that's the business that they're in. And I think the market just said, look, if there's not this big payoff at the end of the rainbow, then I'm really not interested in paying for a very highly levered cable network company until we see more confirmation of kind of this transformation to become a better streaming asset. So, unfortunately, they're stuck kind of in the middle. I think you and I have talked about this in the past. The old world, we know it's where it's heading, and this new world's uncertain, but you need to compete, and they're dead in the middle, and that's a hard place to be right now.
Do you think that, you know, they missed something in terms of the deal itself, and not understanding perhaps that there were certain weaknesses? Or, I mean, I'm not even sure, but you have to ask that question, don't you, when you reduce your EBITDA numbers to the extent that they did?
Yeah, I think there was a lot of spending going on within Warner's under AT&T that may have surprised them. I think the linear business, in the year we've done this, David, has gotten much worse. You know, cord cutting is now running at -6%. That's the worst we've ever seen it. Advertising has weakened, as you just mentioned. You know, the hand became a much more difficult hand in the past 12 months. At the same time, I think there was a revisit on streaming and the economics of streaming, which we've been saying for years now that, you know, the numbers don't make sense. But I do think it's a combination of overspending at AT&T and just a weakening macro. And it's, again, it's a really hard place to be when you're levered as much as they are. So they need to, slow down spending to pay down their debt as fast as they can.
Right. No, as you point out, that 5 times has scared a lot of investors away. Disney's later in the week. What can we take away from what we've seen so far? How much is it going to be judged on subs again and on direct to consumer, or are investors willing to focus on other areas of the company?
Yeah, it's interesting. Like the parks, are going to crush it, but that, and that's been the story since really the past 12 to 15 months. It surprised us, as we said, the park recovery is known to be awesome. There are a couple of things we're focusing on. One is they just lost by choice the cricket rights in India, which has really powered their Indian, DTC business. And the question there is, with losing those cricket rights, will they reduce their guidance for subscribers? The second thing is they're rolling out an ad tier, as is Netflix. We want to hear about the ad tier. And then lastly is profitability, right? Like you've heard the profitability updates from everyone this quarter. And the market really wants to understand, has something changed? Do they want to accelerate the move to profitability? So those are 3 things. I think, the crux of the call will be on streaming again. And everyone's going to ignore the park beat, which will be strong, and then the ESPN trends. It's going to be about, next 2-3 years on streaming, kind of the roadmap forward.